Hey everyone, this week I'm focusing on the tightrope the Fed needs to walk in the coming months as they try to balance the recently released employment and inflation reports. But before I go there, I want to reiterate that the overall economy remains remarkably durable. The first look at second quarter GDP came in at 1.5%, following 2.1% growth in the first quarter. So the current GDP forecast for the full year is still in the 2% range, which is solid. Overall, 2% economic growth should continue to support steady, broad-based commercial real estate performance. Now, as for the most recent jobs report, we once again had some pretty significant revisions. The report shaved 103,000 positions from May and June, while the preliminary July employment number came in at negative 23,000 jobs. So in net, the July employment report took the US from positive 550,000 jobs as of June to just 426,000 positions year to date through July. That reduced the monthly average job creation from about 92,000 jobs per month to about 61,000 jobs per month. And our 3-month trailing average has fallen to just 20,000 positions per month. That's a pretty significant reduction, and it could temper commercial real estate space demand in the second half of the year. We need to factor in that the size of the revisions have become significant, even dramatic. For example, when the preliminary May employment report first came out, it said 172,000 jobs were created that month. 2 revisions later, the May job creation figure stands at just 63,000. That's a big swing. And although about 3/4 of the revisions over the last 4.5 years have been downward, 24% have pushed the numbers higher. So we can't rely too heavily on any one job release by the BLS. The numbers have become too volatile. Now, something that also merits consideration is that the unemployment rate ticked lower in July to just 4.1%. But that's more reflective of a shrinking labor force participation rate. Labor force participation is down to 61.4%, which is the lowest reading in more than 25 years aside from during the pandemic. But while there has been some erosion of participation by people in their 20s, the bulk of the falling labor participation rate is tied to a system recalibration. That dramatically reduced participation by people over the age of 65. So the falling labor force number is more about the aging population and how it's calibrated in the labor force than it is about discouraged workers. But it is still one of the forces holding the unemployment rate lower. Nonetheless, commercial real estate investors should continue to monitor the tepid employment market. We're more than halfway through the year, and at the current pace, the US will only add about 750,000 jobs in 2026. While that may be sufficient to keep unemployment low, considering the shrinking labor force, it's not enough to drive particularly strong real estate space demand. Now, as for inflation, the headline consumer price index went down 10 basis points last month to 3.4% on a year-over-year basis. That aligns with a 10 basis point reduction in core CPI to 2.5%. But we have to put that in context. Remember that the Strait of Hormuz was reopened for the second half of June through July 5th. That allowed about 500 ships to transit the strait, and that took some of the heat off the price of oil and other petroleum products. But since the 5th of July, the strait has been closed and the price of gasoline has been ticking higher. That could reassert inflationary pressure in the months to come. And that's creating a dilemma for the Federal Reserve. Although inflation was a bit lower last month, the forward-looking pressures suggest inflation could push higher in the coming months. And regardless, inflation is still well above the Fed's 2% target. With the economy still facing sustained inflation pressure, Wall Street still expects the Fed to raise rates at some point this year. In general, the Fed is more concerned about elevated inflation risk than they are about the tepid employment market, So there's a strong likelihood the Fed will raise rates by year end. But it appears that rate hike is pretty much already baked into interest rates. The 10-year Treasury has been holding in the 4.7% range, and the 5-year has been in the low to mid 4% range. Those could edge higher if inflation starts coming in particularly hot, but the dominant outlook just calls for a 25 basis point rate increase by the end of the year. And if that perspective holds, then rates should remain relatively stable until the Fed meeting in December. But I do have to reiterate that we are navigating a very fluid economic climate with significant geopolitical and policy-driven uncertainty. Nonetheless, the choppy short-term outlook shouldn't overshadow the numerous positive long-term drivers that underpin the commercial real estate outlook, which is why investors always need to keep their eyes on the horizon.